Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident uranium expert, Justin Huhn of the UraniumInsider.com. If you're liking these videos, support the show. Take half a second right now. Hit the like button. This will jumpstart the algorithm so we can get the word out. Share this with anyone that you think needs to hear it. We've all got that buddy who can't stop talking about NVIDIA and Tesla and his long tech stocks right now. The more people that understand this nuclear renaissance that is unfolding right before us will mean that more people can profit from it. Pay it forward, tell your friends. Justin, thank you for coming back on the show.
I like that intro pitch there. That was solid. Yeah.
Well, if you don't want to buy uranium after that, then we're doing something wrong, huh?
I know, totally. Yeah.
All right. What's the current spot price right now of uranium? We ticked up at almost touched 58. Where have we settled at?
Let's see. I will tell you exactly the last print from UXC. 56.50 mid-market. That was yesterday evening.
Okay. All right. Cool. Last time we recorded, we were around 53. So it's kind of nice. It's just chugging up a little bit.
Indeed.
Yeah. Okay. We got a lot of listener questions. I'll start off with a broad one here from Nautica. Any books, literature, articles, videos you could recommend on how to invest and learn about uranium miners?
I don't know. Well, there's plenty of articles. Off the top of my head, it's hard to specify any particular one. I think honestly, there's some really good content out there on uranium specific investing coming from yourself and myself, interviews that we've done. Rick Rule's done quite a few. There's a lot of content out there. If you just go ahead and Google, do a search within YouTube, you'll find some decent content coming from the folks I just mentioned, myself included. As far as books go, there's actually a pretty decent book by Marin Katusa called The Resource Market Millionaire. I think it's free. It's an ebook. It doesn't, I mean, it mentions uranium. I know that he's invested in uranium, and I think he had a decent role in the previous bull market as far as his own investments go. And it basically just dives into the cyclicality of resource sectors and investing in such things. And uranium is kind of like a cyclical commodity on steroids. And the reason it's on steroids is because it's so slow. The sector is so slow to respond to price. You have these very complicated mines. You're dealing with a radioactive material. There's not many jurisdictions that you can actually mine the stuff in. And so when the price responds, the sector just can't respond like that in terms of production. And that's honestly what we're looking at right now. Is we're seeing a price response. We're seeing a quote unquote nuclear renaissance. Multiple countries around the world are moving towards nuclear or building more nuclear or re-embracing nuclear or expanding on their build outs. So the outlook for the demand side looks very, very good going out as far as you want to go out into the future. However, the supply side is definitely in question, and there's certainly plans for production increases, but they take a long time. And this is the reason why we see big price spikes in uranium. And then we see big contractions that we just went through over the past decade. But check out Marin Katusa's Resource Market Millionaire. And then this book has a couple of sections in it. It happens to be sitting right next to me. I didn't put it there for this interview. It's always right next to me. Howard Marks, The Most Important Thing. There's a chapter on cyclicality that's very good. That's basically, like, I don't know many things for certain in the market. I'm paraphrasing, but what I do know is pretty much everything is cyclical. Bull markets don't go on forever. Bear markets don't go on forever. And if you can play the cycles well, you can make money pretty much in anything. And then there's an excellent chapter also on contrarianism. And so it's probably my favorite investing book in terms of investing principles. So I would look at those two books. And then as far as content goes, I apologize, I don't have an article or anything right off the top of my head. I would say I did an interview back in January with Macro Voices at the beginning of the year or very end of December that was pretty long form, that went pretty deep into kind of the basic thesis. I was speaking to a larger audience of folks that hadn't really heard to a certain extent, kind of the pitch for why go long uranium. So I think that interview did a decent job of going into depth on this thesis, and then just plenty of stuff, content on YouTube.
Yeah, we've got a playlist that's, well, you've got your own playlist now, Justin. We've done so much content, and we've got another
True.
one strictly on uranium, which is you and Rick Rule. So
Right.
if you want videos, that's a good spot for it. I'll toot my own horn there. And then, I got a book on Audible. It was How to Invest in Uranium Now. I don't know if you've listened to that one. It's real down. It's only 30 minutes long, but it's a pretty good macro view.
Nice. Interesting.
And John Quakes on Twitter. If you're not on Twitter, I'll put his link down in the show notes. And man, that guy must tweet out about 30 things on uranium every day. It's impressive.
He's like the Twitter version of Google alerts. You know, you can put a keyword Google alert and you'll get an email whenever that pops up. Basically, John Quakes can sometimes even beat the Google alerts, and you just follow him. You'll get up to date on a lot of the macro developments on a daily basis, pretty much.
Yeah, he's good. He's good. Okay, Fool Auto asks, over the past year, SPUT's average premium to discount has been about 7%, getting as low. Anyways, he's saying minus 2% is about being standard deviation away. Any thoughts on SPUT's premium to discount actually tracking closer to 0%?
You know, it's definitely, I know that it's somewhat of an investor concern for the vehicle, and there's some critique amongst the investing community, in particular, the folks that have recently set up the Zuri-Invest physical fund out of Switzerland, that basically their take was that as these funds mature, they tend to spend more time at a discount to NAV. That's certainly been the case for Yellowcake. Over the past year or so, that's been the case for SPUT as well. We've had a couple of short periods of time where capital has flowed in and they've gotten to a premium and been able to raise cash and buy uranium, but more and more that has not been the case. It's hard to say whether or not that's simply a function of the maturity of the vehicle itself, or if it's a function of market sentiment. I personally think it has more to do with market sentiment. I think when market sentiment is higher, then we see it trade closer to NAV, and then we'll have more frequent periods where they're at a premium and can raise cash. The only problem is, for 2/3 of SPUT's existence, we've been in a generally poor market sentiment for uranium type of situation. Even though the fundamentals have drastically improved over the same period of time, they came on the scene, let's say 6 months before the first leg of this market peaked out, and had a big role to play in the tail end of that run. And then since then, it's basically been one long sort of sideways to downward consolidation for the entire sector in terms of the equities. And, you know, the SPUT is an equity, it's a tradable security, so it's going to act like a stock, and the rest of the stocks have moved in similar fashion. Now, the actual SPUT vehicle, you know, if you chart that, it's looking pretty damn good. Yeah. Even though it's been at a persistent discount to NAV, it's been moving up with the commodity. We just haven't seen big capital flows come into it and push it back to a premium. So, you know, the advent of Zuri, I think, is good for SPUT because it brings some competition, and it's another way of playing the sector. It's going to take a different type of investor to invest in either vehicle. But yeah, I think it'll get back to a premium to NAV. I don't believe it'll ever be in a situation where it'll be consistently trading at NAV. I think it's going to remain majority of the time at a slight discount to NAV at least. And when risk is on and the sector's running, it's going to get back to a premium, and it'll play its role in issuing trust units in the ATM and raising cash and buying uranium. But it's still the most liquid proxy for being long the commodity, and that's something that investors definitely appreciate, is that liquidity and the access to capital. You can buy and sell and settle within 24 48 hours, depending on your brokerage. But different case if you're investing in Zuri, while they trade persistently at NAV, there's going to be a lag time with pulling your money out due to the nature of the fund, if they don't have a cash balance to liquidate your position.
Yeah, I'm going to share my screen real quick, and we brought this chart up many times, but you can see right here, back here in February of this year, it traded at a premium. In January, the same thing, and then last year in November. And so there are moments where this thing shoots up above, we've just been in such a screaming deal for a while now that we're not used to that.
For sure. Yeah. Yeah.
Okay. Let's see. In Europe, we mainly have two uranium ETFs, URA and URNM. Which ETF do you think will be more successful in the uranium bull market?
URNM is probably going to be, I mean, I don't know about successful, but because they are 100% allocated to uranium names, it's going to have more leverage when risk is on in the sector. URA has better liquidity, but it has only 70% allocation to actual uranium mining stocks, but it tends to trade more volume. And I think a lot of that has to do with the options market. It has a significantly deeper options market than URNM does. So a lot of the trades on that particular ETF have to do with market makers dealing with options trades. So we will have to see if eventually the ETF gets large enough that they will go from 70 to 80 or 90 or 100% uranium again. I think that's possible. They're not just going to do it on a whim because they had to reduce their stake in pure play uranium names just simply due to size and liquidity requirements. Doesn't necessarily have to do with sentiment or anything like that. The sector has to be large enough that they can actually be 100% invested in uranium names. So will that happen again? It's very possible that it could happen again. But if you were actually to chart URNM as a ratio against URA, you'll see that when the sector is moving, the sector is hot, URNM does outperform URA. And then vice versa, when the sector is not hot and it's consolidating, URNM usually gets hit harder than URA.
Yeah, would you be able to pull up that graph?
Sure. Let's see.
Yeah, maybe we can pull up URNM versus SPUT, and then because we got some questions here that I think the chart will answer. Is basically you can.
Can you see that? Okay.
Yep.
So this is URNM relative to URA. You can see in general, it's outperformed since its inception, right? It came online basically a couple of months before the COVID crash, and then really took off towards the end of the year. This is sort of where I consider the beginning of the bull market. This is kind of December 2020, right there. So it had significantly drastic outperformance of URA. And that first, robust leg up, then the sector consolidated and underperformed. And then we ran again March, April. Let's see. Oh, this is the later part of August 2021. This is the SPUT, when SPUT came on the scene. Boom, significant outperformance. Then since then, it's been kind of sideways chopped to slightly down. So when the sector tends to run, URNM usually does outperform URA.
Okay. And can you also pull up SPUT versus URNM?
SPUT versus URNM, sure. So SPUT, even though it has traded and will trade at decent discounts to NAV and sometimes at decent premiums to NAV, it generally moves with the commodity. So this chart is going to look pretty similar to charting the commodity versus URNM. So SPUT outperformed URNM pretty significantly. Let's see, when did SPUT's ATM launch? It's launched February 21. This was August 21, September 21. So since SPUT's ATM launch was right about here, SPUT has outperformed URNM.
I should have known that before I pulled this up. I should have done it myself, but I expected it to be the opposite. But
by about 35%. So that's pretty significant. So the metal continues to outperform the miner and the miners. So that's another chart that we really like to look at, which is URNM compared to the commodity itself. So this is kind of the reverse of what I just charted in a way.
Yeah.
So the miners, when risk was on, the sector was going nuts. The miners drastically outperformed the metal, and especially when it first took off, because the metal wasn't even moving and the miners started to run. Now we've had a decent recovery in the price of the commodity, but we've had a big consolidation in the equities. So now we're literally almost barely above the point at which the bull market started in terms of miners' valuation compared to the metal itself.
Interesting. Okay. Cool. Okay. URA and URNM. Yeah, because URA's got, things like lithium and stuff in it, but URNM is a pure play. Okay, from Prigler. How is Justin thinking about the development of the uranium price in this bull market will go? Will it gradually go $70 to $80 and stay there for many years until there's a big uranium squeeze and then shoot up to 150? This is a crystal ball question. What's your likely road for the uranium spot price?
Well, what we're seeing right now with the movement up in the spot price, the fact that it's happening with essentially next to zero influence from the financial players and from SPUT. A little bit of buying happened from Zuri over the past couple of weeks. SPUT did a little bit of buying, like you showed, in late January, early February, but for the most part, the recovery in the price of uranium is happening entirely due to sector fundamentals and actual players within the nuclear fuel cycle. So we're seeing producers buying, we're seeing utilities buying, we're seeing traders buying, and the financials just aren't in there. So it's very constructive to see this, because the moves in the spot price that happened previous to, let's say, the last 6 to 8 or 10 months were largely driven by those vehicles, by SPUT specifically. And that didn't happen in a vacuum, right? Because we had other elements of the fuel cycle moving up, and significantly so since Russia's invasion of Ukraine and the market effectively bifurcating. So we've had big jumps up in conversion and enrichment, big jumps up in UF6 and EUP, and decent moves up in term and spot uranium. Now that is actually finally coming to a head where the demand on the later parts of the fuel cycle are trickling down to uranium. As we've been saying for the past year, that's actually happening right now. So that's all of that is to say that if we leave out the possibility of funds to have an influence and financial players to have an influence and create secondary demand in the market, and just look at the sector fundamentals alone, we're looking at probably north of $80 a pound in the next 24 months, simply based on the fundamentals of the sector. We have to incentivize more supply, period, the end. The demand picture is just too strong going out even a few years, but especially going out later part of the decade, because that's where the utilities are covering right now, which is why it matters. So yeah, we're looking at easily going $80 to $100 a pound with zero influence from the financial players. Of course, we don't believe there's going to be zero influence from the financial players, not only because of what we've already seen can happen, and the fact that evidence is very, very clear to anybody investing in this sector that when the market wants to move the market, they're going to pour money into these vehicles, in my opinion. That's just not happening right now, probably due to general broader concerns about investing due to risk-free, 4.5% money market availabilities and vehicles. So there's so many funds being set up right now too. You have SPUT, you have Zuri, you have Yellow Cake, you have ANU. And ANU is being set up in Kazakhstan. They are going to IPO, I believe it's in Q2 of next year. And when they do, they're going to be buying uranium from Kazakhstan. I don't think it's going to be a buy and hold fund. I do believe there'll be a trader, but still it's a secondary element of demand. Then we're hearing from multiple people that there's at least 3 other physical uranium funds in the works and being set up. One of those we should be hearing about very soon. So we're going to have 5, 6, 7 different vehicles for purchasing physical uranium that are going to be driven by investor capital. That is something we have never seen before. In the previous bull market, we had one that was UPC. Hedge funds were buying uranium, but that was in significantly less volume, for example, than compared to what we've already seen SPUT do, because these hedge funds had to establish accounts at the converters, had to go through the regulatory red tape in order to do so, and then had to hold physical uranium on their books. Now they just have to buy SPUT or buy Yellow Cake or whatever it might be, right? So the fact that all of these things are being set up, in my opinion, means they're being set up because there's investor interest. And if there's investor interest when the risk is on for the sector, I think we're going to see funds flowing into these various vehicles. They're going to have some impact on the market, and considering how thin the market is, that impact could be pretty big. So I would say conservatively 80 to $100 a pound over the next, let's say, 3 years would be where I'm looking. If we see capital flows come in very, very strongly into the sector and into specifically into the physical funds, we're probably going to overshoot that, and potentially dramatically so.
Okay, so 80 to $100 in the next 3 years ish, something like that. Okay,
That would make sense for the sector, because that would help to capitalize these brownfield restarts and greenfield development projects. It would go a long way to helping that supply come online, which is badly needed.
okay. And what last time we were on 3 weeks or a month ago, Zuri was just about to start purchasing. What updates do we have on that?
Well, they're being very, very opaque, and intentionally so. So they don't want to tell the market how much they raised. They don't want to tell them the market how much they're buying. The only thing we're supposedly going to see is a NAV published, a daily NAV published on Bloomberg, which to my knowledge hasn't been published yet. But looking at sort of anecdotal data coming from UXC on this previous Monday, it does appear that they did some buying towards the end of, let's see, we're recording this on June 23rd. So this would have been, I think, like Thursday, Friday, the 8th and 9th, and into Monday, the 12th. It looked like they were doing some buying. Hard to say how much. It looked, from my point of view, it looked like it was somewhere around £1 million, maybe a little bit less, because they were requiring fast settlement. And that moved the price up maybe about $1.50. But of course, there was a run up prior to Zuri, and after Zuri did the buying, it dropped back down about $1.50, and we're sitting here pretty solidly at $56.50 a pound. It's actually been moving up slightly over the past couple of days. So, you know, the spot market seems to be making higher lows in terms of floors. We had the spike last March and April that was totally and entirely SPUT driven, that brought us to $64 a pound. That was not driven by any sort of market fundamental. That was just capital flows. But yeah, right now it looks like I honestly think we've got a floor in the spot market, and probably north of 50, probably 53 to $56 a pound. I would argue is probably going to be the floor going forward, and we might have already seen the recent floor, which is interesting because we're going into the slow period of the year, historically speaking. You know, the later half of June through about mid-August, historically speaking, has been, you know, the summer doldrums. The utility fuel buyers are going on vacation and they're chilling out in Saint-Tropez, whatever. So they're not buying uranium. They're not going to any conferences. Then we have WNA in September and a variety of nuclear fuel conferences in the autumn, and they come back to the table, and that's usually how it works. But this year might be different. That's not just me saying that. We're hearing the same thing from the nuclear fuel consultants, basically saying, yes, the summertime usually is really slow. Don't expect the price to fall. We could actually see continued volume being traded in the term and the spot markets through the slow summer period. So yeah, that was a really long, convoluted answer. Zuri did some buying. They did a little bit of buying, and they'll do more when the capital comes in, and they're not going to tell us when that happens. So it's sort of brilliantly opaque, and I kind of like it.
Yeah.
Less thing I have to track.
Yeah. But, okay, from PBA, current production price of a pound of uranium.
Great question. Well, we can look at the primary producers that are producing now, and that's Kazatomprom, the Uzbeks, BHP at Olympic Dam, Cameco at MacArthur River and Cigar Lake and their joint venture Inkai, and then Orano with Cameco's joint ventures, Kazakhstan's joint ventures, and Somer in Niger. The average cost is probably somewhere in the low 40s would be my educated guess. Kazatomprom is the low-cost producer, along with BHP, because BHP is producing gold and copper primarily from Olympic Dam. So their cost of uranium production is very low, which is why they just sell it into the spot market. The Uzbeks also have ISR production. The data coming from them is almost non-existent. It's a state-run enterprise. So we don't really know their costs. It's probably somewhere in the line of Kazakhstan's cost, maybe slightly higher. Their geology is a little bit different, but it's kind of similar. They're ISR producing. But if you factor in Kazatomprom, if you're talking about, their cash costs are minimal, right? Like less than $15 a pound, sometimes significantly less for the cash costs. But if you look at not even the all-in sustaining cost, but the fully allocated costs, when you're factoring in the dividend that they pay, all of the capital costs to expand and continuously drill, they're easily in the mid 30s per pound and probably pushing $40 a pound, honestly, in this environment for the low cost producer. So then you're looking at, Orano and Cameco, and I would argue that we're probably in the low 40s on average right now. Some of the restarts, the brownfield restarts like Paladin's, Langer Heinrich, they've always said that they are looking in the mid 50s, but that was, years ago before inflation hit as hard as it did. So they probably need prices, kind of where we're at now and slightly higher. And the contracts they're signing are probably in the 60s and higher. But yeah, that's probably the average cost right now. It's somewhere in the low 40s would be my guess.
Okay. If you take them all together and average it out, that's about what we got. Okay. Yeah. Let's see. What's the time window when new mines can come online and substantially contribute to worldwide production? For example, when NexGen finally comes online, will that significantly affect the prices?
That's hard to say, because that one is still significantly speculative, even though they are moving pretty forthrightly in the direction of producing. So I think they're likely to have first production probably in 2028, maybe 2029 if they have some problems with that. There was a recent Canaccord research piece that was done on NexGen where they expected first production in 2027. It's possible, I mean, the Chinese can build an underpass in 24 hours if they throw enough labor at it. It's not impossible to build a mine and a mill and infrastructure for a 800-meter deep, high-grade uranium mine to produce 30 million pounds a year in the next 3 years. But it's probably not going to happen that fast, in my opinion, because mining development absolutely never, ever, doesn't matter what the metal is, doesn't matter where the mine is, never happens on time and on budget. It just doesn't. So, but that's a lot of production. And so by the time they actually start producing, we very well might be out of this investment, even though the commodity itself is likely to have, on the long term, an overall price supportive environment with some fits and starts, especially if we have major capital flow in and come out and flow in and come out of the sector. That, of course, is going to move the needle up and down based on these physical funds. But 30 million pounds per year, according to their feasibility study, is a lot of uranium. It's a lot of uranium. Are they going to be a spot market seller for 30 million pounds a year? Probably not. So they'll most likely be securing contracts, especially in order to de-risk some of the financing of the mine. But it's a monstrous mine. It's basically the biggest mine that will have ever been built in the uranium sector. So that's a big one. Of course, that's quite a few years out as far as near-term increases in supply. Primarily going to come from brownfield restarts, Paladin's, Langer Heinrich, Boss's Honeymoon will be a couple million pounds a few years out. If things go smoothly. Global Atomics DASA, still flagging for 2025 production. That at this point seems a little optimistic, but possible. There's some ISR stuff in the United States that, if everything goes smoothly, maybe we'll have 5 million pounds in 3 to 5 years coming from all of the companies combined. Orano probably going to be doing some saber mining. This is the mining where they drill down to the deposit, and then there's a horizontal radius, kind of a jet boring mining that happens. So it goes down to the deposit and it spins and jet bores with high pressure water, and they extract the slurry straight out of the deposit. They've been testing this. It works great. So there's a number of deposits that are viable for that. Maybe Denison's Phoenix.
I was going to say, isn't Denison doing that exact?
They're doing, Denison's testing ISR. So the saber mining is different because it actually goes down and does bore out the ore itself and extract that in a slurry through the actual bore. Whereas ISR, you're doing a series of wells and you're injecting a lixiviant, like a liquid that will interact with the mineral and be extracted in an extraction well. And they've already tested it successfully. So they're in the last stages of that test phase. And they're already in the process of their environmental impact with Saskatchewan. So they will likely be producing in some manner or another on Phoenix during this cycle. But probably the biggest production increases are most likely going to come from Kazakhstan. And to that point, most of that uranium is going to stay in the East. Not that it's not relevant, it absolutely is, but their two biggest projects. So one of those is the Budanovskoye 6 and 7 blocks. That's this big deposit that they're in development now. And 49% of that was just sold to the Russians. And then the other one is a joint venture with Orano. But a lot of these expansions of these deposits in Kazakhstan are actually replacing reductions in supply from legacy deposits. So, and there's, there's cost increases for them as well. There's problems. They actually had an incident yesterday at their sulfuric acid plant. There were a couple of injuries. I don't know how much it's going to delay, but there's problems, especially when they produce as much as they do. Any type of problem like this definitely affects things for them. So, but we're probably going to see a 5 to 10 million pound per year increase coming from Kazakhstan on a 100% basis in the next 2 to 3 years would be my guess. That of course is needed. So there's a lot of supply, but it's sort of put together piecemeal and quite a few years out before we get to a meaningful amount of supply coming online. And if you look at the models for supply and demand that any of us have done in the sector and the other kind of big names in the investing space for uranium, the modeling that they've done as well is all of what I've just mentioned is baked into the cake, and we still have a substantial deficit, especially when you push out 2027 and 2030. So all of this needs to come online. How much will it affect price? It's hard to say. We'll have to look at the pricing environment when those mines come online. The small stuff in the US, the brownfield restarts, the expansion in Kazakhstan, all of these things are not going to affect price that much. Arrow is chunky. That's a lot. But if they secure the bulk of that production in term contracts, it's not going to have a meaningful downward effect on the spot price at the time it comes online. But again, that's 5 years out. So we very well could see a big movement in the price. We will see a big movement in the price before that happens. Whether or not we will still be at the table invested by the time Arrow comes online, I have no idea. It's possible, but we're probably going to see opportunities to take some chips off the table between now and then.
Okay. In regard to NexGen, we got a follow-up question. They're at least like 3 years out before they're pulling anything out of the ground, right?
Oh yeah, no, I would say at least 4 years, and
4. Okay,
probably 5. Yeah.
So it'll be a while. Okay. Next one. Why hasn't Cameco or anyone else bought NexGen or Fission yet?
Well, I mean, you can speculate on this, or you can actually ask the company, what Cameco has stated in the past, and don't quote me on this, but I'll give you kind of the long and short of it is basically we don't need that deposit is pretty much what they're saying, that they have enough mineral wealth in left in Inkai in Kazakhstan, left in McArthur River, and supposedly with Cigar Lake Phase 2. So Cigar Lake Phase 1 is essentially tapped out, pushing out 2027, 2028, 2029. But according to Cameco, they have Cigar Lake Phase 2. They also own the property on the other side of the border from ISO Energy's Hurricane deposit. That is very, very high grades on ISO Energy's side of things. It's 50-something million pounds at like 30-something% on average uranium. I mean, this is the value of this rock is off the charts. Cameco owns the property right on the other side of the border. It's highly likely that mineralization extends past that border. So they've got a lot of exploration projects that they could tap into in the future in Saskatchewan. They also have decent assets in the United States. Whether or not they'll produce on those or monetize those, I don't know. But that's what they tell you. In my opinion, they missed their chance. They should have gone after it in 2020. Yeah. 100%. but they had a lot of outstanding concerns with the CRA, with the tax and the cap and the credit for the company in Saskatchewan. Some of that has been resolved since then, but it still would have been a decent spend. But what was NexGen at the time? I mean, you can look at the COVID crash low print. I don't know if that's really what we should base this on, but the COVID low was 50 cents for NexGen.
I was going to say like 50 cents or what was it?
They're trading at 450. So they had less than a 500. Oh my gosh, no, they had, let's see, they're 2.26 billion right now. Yeah, I think they had less than a $500 million market cap. Oh. So that was the time to do it. And let me tell you, there were a number of folks in the investing space that were pushing the company and asking the company, why are you guys not going after this? And ourselves included. So they didn't do it, and whatever it makes a market. And the guys from NexGen are pushing to make it happen. They're crossing all the T's and dotting all the I's. They're making the right moves to get this thing moving in that direction. So good for them.
Yeah. Okay. Question on enrichment and Metropolis. What percentage of the world enrichment what is the percentage total of the world enrichment Metropolis can enrich? How much of America's supply needs to be enriched at Metropolis?
Okay, so Metropolis is a conversion plant, not an enrichment plant.
Okay.
So I'll just assume he's asking about conversion rather than enrichment. Because the Metropolis owns the Metropolis plant, ConverDyn, in a JV with Honeywell. Metropolis plant is 7,000 tons a year. So that's the nameplate. And the total conversion globally is 62. So let's see, 7 divided by 62. It's a little more than 10% of global conversion capacity. With that said, they can ramp up to 12 or 13,000 tons. They can almost double their capacity. The problem is that Honeywell, this facility is a pimple on a gnat's ass. It doesn't matter to Honeywell, basically, is my understanding. It doesn't move the needle at all for Honeywell, unless and until they can secure, maybe a couple thousand tons of capacity at $50. Spot conversions trading at 40 right now. So if we see significantly higher prices and they can secure a bunch of long-term contracts at those prices, they might be willing to invest into expanding that capacity. They can do it for less than $100 million. And the cost of operation is about $15 a ton, or $15 a KGU. So there's a lot of profit baked into this, but they're going to have to secure more term contracts at higher prices in order to expand that facility. They're still working on getting it up and running. It was supposed to be up and running a month ago, and they're still seeing delays in that getting going. It literally could be happening any day now. It's crucial that it gets up and running. It's very, very important to the sector. But most of their capacity is booked out through 2027 at 7,000 to 8,000 tons per year. So they have minimal spot conversion available. But some of that capacity is owned, let's say, or has been bought by enrichers. And that's for the purpose of, essentially overfeeding. Yeah.
Okay. All right. From Deep River, can American military enrichers be used if Russia is cut off from their enrichment?
Gosh, that's a very interesting question. I suppose that is possible. I don't think it's going to be necessary, though. Enrichment capacity isn't ultimately the bottleneck, because enrichers can overfeed. They can synthetically increase capacity. So, yeah, we'll have to see. I do think that Russian uranium does end up getting cut off. I do think that that's going to happen one way or another in the next 6 to 12 months. Is probably pretty likely.
Okay. Yeah, we asked Doomberg about this. What's that?
To the U.S. specifically.
Okay. Yeah, we asked Doomberg about this, and he said that basically those Russian molecules are going to find their way to the U.S. and the grid will get fed. He's like, they'll simply sell it to a neutral country, and then we'll buy it from them and pay up for the premium. But he's like, it'll make its way here.
That's possible, but country origin is not something. It's not like oil. It's not like, the Russians are selling oil to India and then they're selling it to whatever other country. It doesn't work like that for uranium.
Okay.
There are swaps that are done, but it never just erases the origin of the material. Origin of the material is with the material throughout the fuel cycle, period, the end. So if they're cutting off Russian uranium, they're going to cut off Russian uranium. So if Russia sells EUP to the French, they're not going to be able to sell that Russian EUP to the United States. But there are waivers within this legislation, and the waivers basically say, if you literally have no other option than to accept delivery from your legacy contract from Russia, then we're going to allow it. But I don't know how specific that is. I don't know if that can be budgetary influenced. Like, we have the option. We can buy some EUP from Urano, but it's going to cost us 3x what we already paid the Russians. So we don't have any other option. Or if it's literally there's no EUP that can be had, which is never the case. There's always something out there. It's just whatever price has to be paid to get it. And ultimately, the utilities with legacy contracts with Russia are praying that they will be able to continue to receive this material, because these contracts that were signed 2018, 2019, 2020 with, let's say, 10x for enriched uranium, they're so cheap. They're so cheap compared to what they'd have to pay now to get EUP to replace these contracts in the short term. So, it definitely will cause a problem in the short term, but enrichment capacity can be synthetically increased through some level of overfeeding. And most of the large utilities are quite intelligent and are first movers in the United States and are well covered for this sort of thing. There's just kind of a few stragglers that haven't moved since last year, let's say, or since everything has happened in the last year, and are still relying on those deliveries. So I'm not exactly sure how this plays out, but I don't think we ever see a situation where the grid is actually in the United States is actually threatened by this material not arriving. It's just that they're going to have to move quickly and pay through the nose to replace it.
Okay. Reactor extensions. If a reactor gets an extension, don't they need to start purchasing this year to fill the inventories? Like with the one in California that got extended, did they wait up until the moment to actually refill that, or were they planning it down to the last rod?
Oh no, they were planning on the plant being decommissioned.
Okay. Okay.
Yeah,
And then they just had to buy that up at the last minute when Newsom gave them the stamp.
Exactly. Yeah. That's not always the case. Oftentimes, if a reactor, it was so clear that California was phasing out nuclear that PG&E really didn't have a whole lot of hope in a life extension. And the movement to save it, while it was, grassroots and has been going on for a while, the real movement that had any sort of California governmental support and legislative support in California, that was sort of last minute. So that was, within the last 12 months before it was supposed to be officially shut down, which is, the first reactor is supposed to shut down next year. So this extension was announced last year, gives them a little bit of time, but they certainly were not holding an additional core loads in hopes for an extension. And they weren't going to go out and buy that material until it was official that it would be extended, because that would be stupid, especially when it comes to fabricated fuel, because it's unique to that reactor. Maybe they could have speculated and held some UF6 and then sold that back into the market if the decommissioning had gone through, which actually probably would have been a good trade for them, but they didn't do that. So they've been out in the market with an RFP, pretty chunky one, 6.1 million pounds of U3O8 equivalent, looking for UF6 and EUP. That RFP has been out in the market for 2 months. They've yet to make a decision. They're still evaluating offers. So in some cases, when the decision is made sort of in the last year or two of the plant's expected life, and then it gets extended, they will have to come back into the market, because they're not going to spend, a pretty healthy amount of money to secure that fuel in order to have a maybe core load that is going to be needed. So and this is shaking up the market a little bit, this RFP, because of its size and its relatively near-term delivery. So they're looking for 2024 to 2029 delivery for a 5-year period. but they're looking specifically for UF6 and EUP because they need it so quickly. So if they went out and bought U308, then they'd have to buy SPUT conversion, which is $40 a kGU. And then they'd have to buy SPUT enrichment, which is, I don't have the price in front of me, it's very expensive, and fabricate fuel. And that process would take 18 months to 24 months, right?
Okay.
So if they can skip that first step and buy UF6, then they can skip that step and make the process easier for them. But what we've heard essentially is that certain players within the fuel cycle services industry, in an attempt to respond to this RFP for UF6 or EUP, have put out their own RFPs for uranium and have had insufficient offers come back. So the volume they were looking for, they did not get offers for that amount of volume. My understanding from speaking with these folks and speaking with other people in the industry is this doesn't happen. This is basically an industry first for an RFP for a couple million pounds of uranium for delivery in a couple of years not being filled. So that's how thin this market is. And we're pretty much talking about the spot market and the near term, short term market. And the reasoning it's so thin is the primary producers, they're basically sold out for the next 3 years. It's just not there. So the utilities, the utilities that are late to the party are going to have to really pay up. They're going to have to raise that offer in order to shake some pounds out of the market. And that's what we've seen. That's part of the reason why we saw the price jump up $5 even before Zuri purchased a single pound. Maybe some of that was front running Zuri, but I don't think so. I think a lot of it had to do with the movements in the market due to this one RFP. So yeah, very, very, very thin.
Okay. When do Japanese restarts needs to start ordering uranium? So they're coming back online. We're up to like 13 of them now, right? And they're going to keep opening each one up. Do you know when do they actually buy the uranium? Is it 6 months before they restart it, or?
So we can't really sum all of the Japanese utilities into a single, Japan, let's say. So there's a number of Japanese utilities that own reactors that have been fully decommissioned. So they are either still holding on to some inventory or they sold some of that inventory in the market over the past 10 years. We're currently at 10 restarts, but there's 2 more coming online in the next 2 to 3 months. I think that's the Takahama 1 and 2, if I recall correctly. Those 2 should be restarting. There's possibly a third towards the end of the year, although that one's been delayed a little bit. And I think that third reactor is going to be the first boiling water reactor to restart in Japan. Okay. As of now, all 10 have been light water reactors, including the 2 that are going to restart in the next few months. So Japan still has some inventory. Most of that, over half of that inventory is in enriched uranium. Which EUP, although it is fungible, it is enriched to a specific level of enrichment for a specific reactor. So it can be sold back into the market to some extent, but if it's specifically enriched to 4.7% for these 2 specific reactors, and there is a hope that those reactors are going to restart, or they have restarted or are about to restart, that material is not coming to the market. But also, in the same breath, they don't necessarily need to come in and buy uranium immediately. So it's different than like the PG&E Diablo Canyon restart, where they had to come in and buy because they were expected to shut down. What we have now is 20-something reactors in long-term shutdown, but are operable. And some utilities still have some inventory. But with that said, we do know that the Japanese have been signing contracts. We do know that they've been in discussions with Cameco. And when I say the Japanese, it's a few utilities in Japan that are looking to sign contracts to bring more material in. So some utilities are sellers, some are buyers. On balance, they are going to be buyers going out into the future.
Okay. All right. Uranium stocks in Africa are all trading at a big discount relative to other uranium stocks, considering the proven uranium in the ground. Is there a good reason for that? Are they that they're extremely undervalued? I've noticed this with copper. I've been looking at Ivanhoe copper for a while, and it is a screaming deal, but I just can't bring myself to pull the trigger because it's in Africa.
Well, there's pretty big differences between the different countries in Africa, right? Like Namibia versus the Congo, two
Yeah.
totally different, very, very different places, very different in terms of jurisdictional risk as well. Well, the primary countries in Africa that deal in uranium are Niger and Namibia. Most of the companies in Namibia are listed on the ASX for whatever reason. So I don't know if the underperformance has to do with that. What I have noticed is the ASX listed stocks tend to have leverage to the rest of the space, on the upside and the downside.
Okay.
So when risk was really on and the sector was on fire, like let's say, August to November of 2021, the ASX stocks pretty drastically outperformed the Canadian and the US listed stocks. And then most of them have pulled back more during this consolidation period, with a couple of exceptions. Some of the larger caps, Paladin's held in decently. Boss is a beautiful looking chart for whatever reason. But some of the other small and mid cap ASX listed uranium mining stocks have pulled back, a lot. So some of it just might be that leverage of those crazy Aussie resource speculators that just go nuts when the sector's on fire, which I love. But some of it also has to do with a little bit of jurisdictional risk that is of late in Namibia, which is we had, I think it was the Minister of Mines. I don't know if that's his official title or not, so my apologies if I'm butchering that. But basically the guy who's in charge of this sort of thing in the country, saying that new mineral licenses within the country would have to deal with the country directly as far as having a stake, the country of Namibia having a stake in the mine itself. And this is something that's already established in Niger. The country of Niger has, by default, 10% stake in anything that happens in the mining industry in the country, and they can negotiate that stake higher. For example, they have a 20% stake in Global Atomic. 10% of that is obligatory. The additional 10%, they actually have to share in the cost of development of the mine to that 10%. But it's understood by the market. Niger is one of, if not the poorest countries on the planet. It obviously has some level of volatility and instability politically that some of these, very, very poor countries do inherently. But they also have a long-standing history of uranium production. The French have been there forever. They've been producing at Cominac and Somaire. Cominac was shut down a couple of years back. Somaire is still producing. They've got very large mines in development and potential development in the country. And then, of course, GoviEx and Global Atomic are there as developers. So is there some risk in Namibia and Niger that doesn't exist in other jurisdictions? Yes. Maybe that has a little bit to do with the slight discount that we're seeing on these particular companies relative to the rest of the market. But there's also a very long-standing history of uranium production in both countries. So I suppose maybe that's the reason, combination of just the ASX beta that can happen in consolidations, or the other geopolitical things that I mentioned there. It sounds like that risk in Namibia is only for new licenses. So the established companies that are there, as far as I understand, don't have any risk from what the country is stating as of now.
Okay. All right. Okay. Last question from Stoic Flipper. What is Justin's exit strategy once the uranium market takes off? Do you have specific price targets, or are you looking at how do you know when it's time when it's run its course?
Sorry, I got stuck on the person's name. I like that name. I don't know if they're like a house flipper, like they're buying the shittiest house in the best neighborhood and fixing it up and reselling it, and they're stoic about it. Or I'm picturing like the dolphin flipper. I guess flipper was pretty stoic. Just kept it low drama. I don't know why I really like that name. Exit strategy. Yeah, you're gonna want to trim on the way up. You're not gonna want to hold a full 100% positioned portfolio and try to time the top, because you won't be able to, and I won't be able to, and nobody will be able to. So make sure you pay yourself on the way up. Usually, the best indicators of that are RSI. Honestly, looking at RSI and looking at, oftentimes when you see a euphoric quote unquote blow off top, You'll see a slightly higher high from the previous top that usually was weeks or maybe a few months prior to that blow off top, and lower RSI on the daily charts. So that's a big indicator that you're making, you've got some bearish divergence in the RSI. That was pretty obvious back in November 2021. Although it wasn't extremely blow off top-ish or euphoric, because SPUT was buying hand over fist, and if they continued to do so, we would have kept going higher regardless of what all that the RSI said. But that's something to look for from a technical signal. Obviously, you're going to look at volume coming into the sector. Usually the biggest volumes are close to the top, daily and weekly. You're also going to want to look at evidence in the physical market of new sellers coming in. That's going to be harder to see. That is something that we will be able to express to our membership, almost in real time. That will help on the way, help us time the ideal exit position. But you're going to want to make sure you take some chips off the table on the way up, regardless of what I say or what anybody else says. So the sector is just so volatile that, on the way up, peel off in tranches. Don't hold that entire full position until the top. I mean, do whatever you want, but I wouldn't suggest that, because it's going to be hard to sleep. You will miss the top. And for me, trying to exit full positions and time that top only to see the sector go higher the following day, the following week, the following month would be extremely, extremely painful. So psychologically speaking, so I would rather sell down the bulk of my positioning as we're moving towards that blow off top, maybe hold a speculative position and try to time the top. Maybe that's 10% of what the original position was, but you're going to want to make sure you pay yourself on the way up. So that's my main strategy, is tranche in and tranche out, just to protect your own capital for the most part. And being in the United States, for me, we're long-term holders for the most part, and a lot of that has to do with capital gains taxation in this country. Some countries you don't have to deal with that. So if you're watching this from wherever it might be in the world and you don't have those concerns, you might have a slightly different strategy. You might trade more often. You might try to time these intra-cycle highs and lows and trade in and out, and improve your cost basis, and more power to you. For me, I want to screw the tax man as much as I can. So I don't like to trade in and out of these stocks a lot. I like to add on weakness and hold for the big move, and ideally lock in long-term capital gains, which for me are almost half of what I would be paying in short term. So yeah, tranche in, tranche out, to put it in a sound bite.
Yeah. Trim your position as it goes. Well, Justin, thank you very much for coming on the show. If you want to check out all things Justin, go to uraniuminsider.com. There'll be a link down in the show notes. Justin dissects the sector so that you can play the alpha instead of the beta. Justin, thanks again, and you have a great rest of the day, sir.
Nice tagline. Yeah, thank you. Thanks, Steve. Good to see you, man.
All right, man. Take care.
You too.